esteemed members who have just logged in for this another scintillating webcast by the Board of Internal Audit and Management Accounting. Good evening to each and every one of you. I'm conscious we are in the month of May. I'm conscious we are in the month of heat. I'm conscious we are in the month of mangoes also. So, friends, May is a joyous month. A month where we celebrate with our holidays. A month where we go to new destinations with our near and dear ones. And a month to sit back, relax, and re-energize ourselves for the coming months of the year that are going to be taxing, that are also going to be challenging. So friends, on your screen, we can see our very esteemed Charanjot Singh Nandaji, the Vice Chairman of the Board of Internal Audit and Management Accounting. Of course, he is currently traveling now. You can also see the faculty of today's evening, CA Sana Bakai. And we also have here with us CA Satish Sadaji. Esteemed friends, on behalf of the board, on behalf of each and every one of you, I very heartily welcome Charanjot Singh Nandaji, our mentor, our guide in this particular board. We thank him for sparing his valuable time. And I also welcome CA Sana Bakai, who has agreed to take us through today on box ticking, a topic which is going to be very, very extremely interesting, because the topic is so interesting beyond box ticking. That's a very interesting topic, Sana. Thank you very much for accepting our request and being here and sparing your valuable time. And we also have here our co-opted member, CA Satish Sadaji. Satish ji, thank you for sparing your time and being with us here today. Friends, I will not stand before you and Nandaji or the speaker. I immediately would request Nandaji to start the proceedings of the day. Thank you, Nandaji. Thank you for being with us. Over to you.
Thanks a lot, my chairman, GST man Rajinder Kumar. A person who believes in contributing, a person who believes that every action taken towards empowering members, honing their technical skills, ultimately takes this profession to unprecedented heights. I have always been influenced by him, and he has been always perpetually serving this great institute. Day and night, he has been working to ensure that the institute reaches the pedestals of highest success. Ladies and gentlemen, we have with us CA Sana Bakai, the speaker of the day. My very dear friend, Mr. Satish Sada, who is a moderator as well as a co-opted member of this very scintillating board, and all who have joined today. Ladies and gentlemen, the basic thesis of today's webinar is internal audit and controls. There is a saying which says that a chain can never be strongest than its weakest point. Yes, if there is a weak point in the chain, it will break from there immediately. If there is a weakness in the control system, that would invite frauds, that would invite misappropriation, and more importantly, this control environment, if it is strengthened, will give the board, the audit committee, right weapons to create value and worth for all the stakeholders. Yes, internal audit essentially is a management function. We work, we report to the audit committee or to the board and see that they are able to take informed decisions. We determine the level in which they have to work. The risk appetite is determined by the board. But we go across and see how things have to be put in the right esteem. And internal audit in context with the Companies Act today would again be one of the very scintillating features of today's presentation. The speaker, Sana Bakai, she is a dynamic professional with over 17 years of experience as a professional chartered accountant. She is a brilliant author and entrepreneur with excellent leadership qualities and a track record of successful leading teams to execute futuristic projects in tune with the fast-changing times, nurturing exponential growth. Her niche has been audits, taxation, management consulting, strategic planning, and leadership with a focus on organizational profitability achievement. I can see that all are very eager, including the chairman, to listen to her words of wisdom and to drive home certain issues that would have made you feel doubtful over the years. So, not standing between you and the speaker, I would first invite the chairman so that he could invite the speaker, and then all of us will join hands and listen to what the speaker has to share with all of us. Over to the chairman, Mr. Rajendra Kumar.
Thank you, Nandaji. Thank you for showering your blessings on all of us in the board as well as the speaker of the day. Yes, as rightly said by him, I now request Satish Chadaji to please introduce the subject and then take over for the next few hours of this proceedings. Over to you, Satish Chadaji, for your introduction of the subject and for your deliberation, and then handing it over to the speaker of the day, CA Sana Bakai. Satish Chadaji for all of us.
Thanks a lot, Honorable Chairman Shri Rajendra Kumarji, Vice Chairman Shri Charanjot Singh Ji Nandaji, and esteemed board members for co-opting me on this prestigious Internal Audit and Management Accounting Board. And I also thank the esteemed board for giving me the opportunity to moderate today's webinar. On behalf of the board, I welcome all the participants to this webinar, which is very aptly titled Beyond the Box Ticking, Internal Audit and Controls, Companies Act Perspective. We have a very distinguished speaker for the session, Ms. Sana Bakai, who will guide us about various internal audit tools, procedures, and beyond box techniques to perform the internal audit and in best possible manner under given circumstances. My dear professional colleagues, a very good afternoon. The business landscape has become very dynamic and demanding. Ever-changing rules and regulations, employees' integrity, cyber security, sustainability are the latest challenges. So the need to create greater transparency, established sound corporate governance, and understand risk exposure becomes all the more necessary. Non-compliance with the provision of internal audit and internal finance control will definitely have a cost. But ineffective compliance will have a greater cost. So here comes the role of effective internal audit, effective internal control, and effective risk management system. But the first and foremost point is whether companies undertake internal audits only because there is a statutory binding to do so. In my opinion, companies should be made aware of importance and vast benefits of internal audit and internal finance control so that they themselves, with or without the statutory bindings, should come forward and ask for implementation of effective internal audit and control system. But again, the question is when they will come to us. They will come to us when we are able to prove that internal audit system is not just a cost to them, but it is a value addition to their business. With our professional expertise and conduct, we have to convince them that internal audit system will prevent the occurrence of frauds and errors, can give reliability to the management information system, better decision making, better compliance of rules and regulations, reliability to the financial reporting, etc. For this, we have to enhance our skill and competence with the help of digital, intelligent, and analytical tools and techniques. And above all, we have to replace our tick the box attitude with the beyond box approach. Frauds and errors will never be eliminated with ticking the box approach. We have to apply our analytical investigative mind and look for the core reasons for frauds and errors, and then devising the system to eliminate or at least reduce them. Our role should be insightful, proactive, and future focused, at the same time maintaining our independent integrity. Internal auditors can be a mix of chartered accountants, company secretaries, cost accountant, and even technical experts. They can be practicing or can be employed also. So capacity building is the need of hour. Once it is done, then sky is the limit. I'm pleased to inform you that our learned speaker will explain you about internal audit, internal finance controls, internal control over financial reporting and risk management with a beyond box perspective in them, which will surely help us in devising a robust internal audit mechanism. If you have any question, please keep a note of it or post it here. We can take up the same after the presentation. So now I request Ms. Sanaji to please start with her presentation. Thank you.
Thank you, Satishji. Over to you, Sana.
Thank you so much, sir. Thank you, the Chairman of the Board of Internal Audit and Management Accounting, Mr. P. Rajendran, Vice Chairman, Mr. C.S. Nanda, and the moderator for today's session, C.A. Satish Sarda. I heartily welcome all of you for today's session. I hope I'll be able to meet your expectation with the title Beyond Box Ticking, Internal Audit and Control. As we all know that the Companies Act 2013 has brought about significant changes to the corporate governance landscape in India. And one of the key reasons where these changes are being felt is in internal audit and control. It is no longer enough for companies to simply tick the boxes when it comes to internal audit. They must go beyond that and ensure that the internal audit and internal control processes are effective and compliant not only with the Companies Act requirement, but other statutory requirements as well. I hope you will find this session informative and engaging, and I encourage you to participate actively in the discussion that will follow the presentation. Whatever questions you have, you keep on posting there, and we will then take it up towards the end. I'm sharing my screen. Just let me know if it is visible to all. Thank you. So with this concept, with Mr. Satish Sarda has already set the context for today's session. Let me start with the presentation. Today, we will be talking about, of course, the internal audit, IFC and ICFR, risk management, and the beyond box ticking. The era of corporate governance in India has started long back. In 1998, when CII has voluntarily issued the Corporate Governance Code, and it has been welcomed and implemented. Later, the same was considered with the Mangalam Birla Committee report in 1999. Following that, the SEBI has introduced Clause 49 to the listing agreements for all the listed companies. Then DCA set up the Task Force on Corporate Excellence. If you see from 1998 to 2021, a lot of changes has been done. Various activities and initiatives has been taken on the corporate governance part. Then Naresh Chandra Committee report in 2002. They again revisited the effectiveness of the existing corporate governance and suggested certain more changes for the reporting, specifically for the listed companies. DCA report was issued. Then we have the Narayan Murthy Committee. which recommended certain more suggestions on it. Based on that, 2014 clause 49 has been amended to include those changes which were suggested by Narayan Murthy committee. Then the Companies Act 2013 was introduced, and the concept of IFC, internal audit, and ICFR was introduced in 2013. 2015, SEBI come up with the LODR regulation for the listed organizations, including certain aspects for improving the corporate governance, because the stakeholders for the companies are increasing day by day. With the fraud and the risk happening across, with the change in the landscape, business landscape, the way people were working, introduction of the technology, use of technology to an extent when it became vulnerable in certain cases. Then GST was also implemented as a part of the corporate governance, where for the improved governance and ensuring that it is picking up and the loopholes. Then in 2021, SEBI LODR regulations has been amended, and the emphasis was more on the role of the risk management committee. The Companies Act is also evolving. The Companies Act, the rules associated with it, is also focusing more on it. Concept of integrated reporting has been introduced. Over a period of almost 2 decades, we have reached to an extent that from where we were starting, now the people are focusing more on the sustainability. Now the talks are going around ESG. The governance has changed over a period of time in India. So as the internal audit, the evolution of the internal audit over a period of time from 1998 till date has drastically changed. Initially, internal audit was before introduction of the Companies Act 2013. Internal audit was not a compulsory activity for any company. It was only a clause in the CARO that the statutory auditor is required to comment on whether the companies are maintaining the financial controls, whether they have conducted internal audit with the frequency which commensurates with the size and nature of the business. So initially, when the internal auditors were hired, the focus was more on the verification. They were seen as the person who do detailed verification. They were focusing more on numbers and compliances. Gradually, when the CARO was introduced, then the focus has shifted from verification to the evaluator also, when the talk about the internal controls has been there. Following that, with the introduction of the Narayan Murthy committee report, the focus has shifted from the evaluator to the problem identifier. The focus is not only on the systems and the processes, but also on the controls. Now, the internal auditors were looking as those who were identifying the problem, but who was there to solve that? Then internal auditor also embraced that role and started providing the solution for those issues which they have came across during their audit. They started focusing on the objectives and the risk management. Now, the internal auditor are more of a consultant or a business partner to the organization. They give assurance and focuses on value addition and corporate governance. So in the last 2 decades, initially, internal audit was not a big function which the companies were looking at, but now A lot of organization, even the startups, are doing the internal audit for the enhanced governance. Even if it is not compulsorily applicable to them, they are taking up internal audit as a voluntary activity as well. So what internal audit is all about? Let's understand. CA Institute has issued a definition. It was given in the framework of the standard of internal auditing, which was revised in 2021. Recently, it has been revised. It says the internal audit provides independent assurance on the effectiveness of internal controls and risk management process to enhance governance and achieve organizational objectives. So if you look at this definition, it has 4 limbs. First, foremost important, independent assurance. Whatever is the capacity of the internal auditor, be it an employee or an external one, doesn't matter. Independent assurance is something which is being emphasized on the effectiveness of internal control. The internal auditor is required to give assurance on the effectiveness of the internal control. Here, the adequacy of internal control has not been focused. Adequacy of the internal controls is the role of the board, management, and the statutory auditor. Here we are talking about the effectiveness of the internal controls and risk management processes. Risk management, which has been evolving, the risk management framework, we will discuss it later during the presentation. The focus has also shifted to risk management as well, to enhance governance. Of course, the focus of the internal audit is to enhance the governance with the concept of the sustainability and ESG and other recent developments in this domain has also been incorporated in this definition and achieve organizational objectives. Of course, so ultimately, the internal audit is based on these 4 limbs to achieve the organizational objectives. The role of internal auditor has increased when we talk about this definition of the internal audit, which has been revised recently by ICA. If you see that over a period of time, there is a paradigm shift in the role of the internal auditor. Initially, the internal auditors were seen as a reactive, somebody who find out the problems and react to whatever has already been done. Now the role has evolved from reactive, they became proactive. The proactiveness comes from when we are talking about implementation of controls, preventive controls. So it is not only the detection, but prevention of the controls. Prevention controls have been implemented, and the role has, of course, been shifted. Earlier, the focus was on business, on books. Now it is shifted on the business. It used to be around the vouchers, now it is around systems. Of course, over a period of time, I remember that while we used to audit initially during our articleship days, we used to get a lot of physical records. Now those physical records have been skimmed down, and only the supportings, etc., these are available in the hard copies. Most of the things, the accounting, the books, have already been in a digital mode. It's all on be it on a SAP or any other accounting software which is being maintained. Even in case of companies, almost all the companies are on it. So from the vouchers where we used to just do the verification, now to the systems where we are working more on enhancing the value for the business. Previously, the focus was on sales. Now it is on value addition. And from the economic value addition, it has now shifted to value creation. How an internal auditor can add value to the company. Earlier, it was taken as a cost center. Now it is no more a cost center, but considered as a support role or a partner for the business. The focus was on the quantity of earnings. Now it is on the quality of earnings. If you see in this integrated reporting concept, HR is also considered as an asset, the human resource which we are having, the environment in which we are working. The focus has been shifted from there. Then from delayed accuracy to the quick estimates, from just internal controls to the internal cooperation. From you versus we to all of us, from stern looks to a smile, just an internal audit to the external internal audit. There is a huge shift when we are talking about this difference. It clearly says that the internal auditor was not only work as internally, but given independent assurance. So there is a shift from internal audit to the external internal audit. Internal auditor were earlier perceived just as a professional, now as a partner. From the consultant to the core group member, from the long reports to the crisp elevator pitch, from conceptualization now to the execution. It is not only the concept or the solution for the problems. Now internal auditors are also being seen as those who are implementing those solutions for the organizations. And from compliance with just the standard accounting, where we know that what all has to be debited and credited, now it is compliance with the accounting standards. From tax planning to tax compliance, from checker to the consultant, compliance to competency, foe to a friend, fault finder to facilitator, just focused on the net profits to cash flows. Cash flows being very crucial, the focus has shifted. Large cash as a source of comfort to large cash as a cause of concern. So the role of internal auditor has evolved almost 360 degrees over a period of time on different aspects, what they were perceived earlier and how they have been considered now. Ultimately, the objective of the internal audit is the compliance to the external as well as internal risk and controls, the whole of the risk management, then optimization of resources, cost and processes, then governance processes and ethical practices. So with these objectives, when the internal audit has been conducted, it gives value addition to the organization. So when we talk about internal audit, for Companies Act, Section 138 comes to our mind, where the internal audit has been made mandatory for certain class of companies for the first time in the history of the companies. In 1956 Act, the Companies Act 1956, there was no such provision which makes internal audit mandatory for the companies. So for the first time, this section has been introduced. the internal audit has been made mandatory for a specific class of companies. And the board of directors of that company, they may appoint the CA, cost accountant, or any other professional to conduct the internal audit. And internal audit may or may not be the employee of the company. So let's see what are those class of companies on which internal audit is being made mandatory. So if you read section 138 along with the rule 13 of the Companies Accounts Rule 2014, it has been defined. There are 4 parameters on which it has been tested. So for listed companies, it is compulsory, no exception. For all listed companies, it is mandatory to do the internal. For private and unlisted companies, of course, the small companies has been excluded. They can do it, but it has not been made mandatory for them. So the criteria for the private limited companies is turnover and the outstanding loans or borrowings from banks or public financial institutions. The turnover, it should not cross. So if the turnover has crossed 200 or more during the previous financial year, then it is mandatory for the internal auditor to appoint the internal auditor, for the companies to appoint the internal auditor. So private limited, turnover 200 crores or more, and outstanding loans or borrowings 100 crores or more at any point of time during the previous financial year. So for this year, as in the ongoing year is 23-24, what you need to see, these limits has to be seen during the financial year 22-23. So for the for the year ended 31st March 23, if the turnover has crossed 200 crores, then yes, you can go for it. Then it is compulsory for the companies to do the internal audit. It has been made mandatory. Or the loans at any point of time. So even if you have taken the loan, but repaid during the year, doesn't matter. But if any point in time during the financial year, these limits have been crossed, then it is being made mandatory. So these 2 criteria applies on private companies as well as on the listed public companies. However, there are 2 more additional points which has been given for the unlisted public companies. 2 more criteria, that is paid up share capital 50 crores or more during the previous financial year, or the outstanding deposits of 25 crores or more at any point of time during the previous financial year. So if you see at point number 2, where it was talking about the outstanding loans, borrowings from banks or public financial institution, it clearly excludes the private lending schemes. It is only from the banks or the public financial institution. This is to ensure. So basically, this is what? This is an enhanced, this is a step towards the enhanced governance. To ensure that the public money is safe with the company, it is being made mandatory for them to do the internal. Paid up share capital, of course, in the public companies, even though it is unlisted, anybody can hold the shares. That is why this is an additional requirement. And the deposits. Private limited companies cannot accept deposit. That is why this limit, this criteria has not been given for them. However, for the unlisted public companies, yes, they have to see if at any point of time they have collected money from people, as in 25 crores or more during the previous financial year. In that case, yes, it is being made mandatory for them to appoint the internal auditor. So at times it happens that after the say for year ended 22, you were meeting one of these conditions and went for the internal audit for 2023. It was mandatory. However, for the year ended 23, you are not meeting any condition, but for corporate governance, for a better governance of your company, they can do it on a voluntary basis. So if any point in time, company is not meeting with any of these requirements, they can simply step out from them. One very important thing, be it a statutory auditor or a cost auditor, they have to confirm the adequacy of the internal controls in their respective audit reports. So they rely more on the internal auditors in these cases. When we talk about the eligibility for the appointment, internal auditor has already been discussed. They can be CA, the cost accountant, or any other professional as may be decided by the board. So it includes the other professional, includes company secretary, it includes computer engineers, civil engineers, etc. If the nature of the company is so that they want to have a diverse team, people with technology, those who are working in tech-driven companies, internal auditor can be a technical engineer. Even the engineer can be appointed as an internal auditor. There is no restriction in the company law which prohibits appointment of any professional. So it's on the board that how they want to and whom they want to appoint. So the competition for the chartered accountants is more in this segment. The internal auditor may or may not be an employee of the company. Of course, it is not necessary that you need to be external. Of course, you need to give an independent assurance. There is no doubt in that. You have to be independent in your approach, but you can be, if you are the internal auditor, you can be or cannot be the employee of the company. It depends on the company whether they want to have an internal audit department in-house or they want to outsource it, or there are certain organizations who work on co-sourcing. So there is no restriction on that. So when the term which is being used, chartered accountant, this means CAs, whether they are engaged in practice or not. So for internal audit, you need not to hold COP. It is just that who are registered with the Institute of Chartered Accountants of India, they are eligible. Irrespective of the fact whether you are holding COP or not, doesn't matter. So the board, they can, through the audit committee, they are free to appoint any professional who is competent to be their internal auditor. And section 143 prohibits that those who have been appointed as the statutory auditor, they are not eligible to be the internal auditor. So internal audit and statutory audit both are independent functions. One who is appointed as the internal auditor cannot be appointed as the stat auditor, and vice versa is also have been clarified. So they are not eligible to provide the service of whether rendered directly or indirectly to a company or its holding company or subsidiary company. So you cannot be, the statutory auditor cannot be the internal auditor for the whole group of that company. For that company, they're holding subsidiary, no one. They cannot be appointed as the internal auditor anywhere else. As an internal auditor, what all are the competencies which you need? Independence, integrity, objectivity, due professional care, confidentiality, skill and competence. Independence, of course, as you have already seen that this is the basic requirement, which even the definition of the internal audit also make it mandatory. that it has to be an independent assurance. So you need to be independent, and you should not have any kind of undue influence or the forces which lead you to deviate from the truth. It is not only in mind, but also in appearance. Integrity, when we talk about integrity, it means honesty or the truthfulness. Whatever you come across during the your audit process, you have to deal it fairly. If you come across a fraud, or maybe you just find out something which pops up during the audit, which you think that can lead to a bigger fraud, you have to be honest enough to report it to the next level authorities, to the management or the board or to the shareholders, and need to report it in your reports, maybe to the stat auditors and all the respective stakeholders. Objectivity, again, as an internal auditor also, you need to be very objective in your approach. So if you see that these basic competencies are similar to what is expected from the stat auditor as well. It is not, there's no difference between these competencies when it comes to be the stat auditor or the internal auditor, doesn't matter. You need to follow the same level of objectivity, and you need to exercise the same level of due professional care while conducting the audit. Confidentiality, whatever you come across during the audit, you have to keep it confidential. You should not disclose it unless you have any legal requirement to do so. Other than that, whatever information you have, you need to keep it confidential throughout. Skills and competencies, again, this is highly needed in today's time. Internal auditor need to have the right skill set and competent to handle today's job. You know, before COVID, it was easy. Of course, the technology was definitely, it was there. We cannot say that it was not there, but you have seen in the last 3 years, there is a huge shift in the way people are working. The companies are working, even the chartered accountants are working. The adoption of technology in each and everything has increased 10 times in last 10 years. Adoption of technology, a lot of softwares, tools, techniques are being made available to work remotely. There are a lot of technology came in terms of artificial intelligence, robotic processes, which has been implemented a lot. So while we are talking about the use of the artificial intelligence, are you aware? Are you able to handle that? The concept of the blockchain, where gradually everything will move. So are you competent enough to understand those technologies? Are you competent enough to understand the softwares, the ERP systems, SAP, etc., which has been deployed by the companies on which they are working? So if you do not have the right skill set, if you do not have the right competencies in skills, knowledge about what you are going to audit, then you cannot do the audit successfully. Of course, all these competencies are irrespective of the fact whether you are an internal auditor or the stat auditor. It is the basic necessity for all the auditors to follow. So when it comes to the scope of internal auditing, it has not been prescribed anywhere in any act or rules. The Companies Act does not talk about what exactly should be the scope. So the audit committee or the board, in consultation with the internal auditor, formulate the scope, functioning, periodicity, and methodology for conducting the internal audit. So it depends on the size and the nature of the organization. For example, if it is a company which operates across borders, then of course the scope would be a little different. If it is just a small company operating at one place, it could be a little different. And the scope would be different between a technology company or a service provider to a company which is dealing in some, say, FMCG products. So scope could be very different and when it comes to the nature of the company. It depends on if it's a capital intensive company where the capital is more. So if it is a real estate, then things would go very differently. The nuances of every industry is different. That is why the scope has not been defined over here. As an auditor, what is really important is to bring value addition. What value addition you are able to bring to the table of the board? What exactly you will be able to do? So it's all about efforts versus the value which they are getting. When we talk about efforts, it would be your time and resources. So value could be, you can advise on the internal weaknesses of the controls, can add reliability to the financial statement, find and stop instances of the frauds, make use of an auditor's expertise, give confidence to the management that the work which has been given to you has been duly executed. So moving on to the next segment, let's understand what IFC and ICFR is all about, the internal financial control over financial reporting. In short, I'll call it ICFR and then IFC, what all differences and how it is being implemented. So in this Companies Act Sorry, there was a technical glitch. So we were talking about the director's responsibility statement. Section 134 talk about the director's report and the content. If you see, the IFC has been included in the director's responsibility statement as well. It is not only the auditors who need to talk about the internal audit or internal financial control, but the Companies Act make it an obligation on the directors as well to ensure the advocacy and the effective operations of the effectiveness of the internal controls in the company. Next statement which they need to say is the directors had devised proper system to ensure compliance with the provision of the all applicable laws, and that such systems were adequate and operating effectively. So again, they are talking about the compliances with the provision of the law as well. And whether these systems, again, the compliance being part of the financial control, they're talking about it, the directors have to report on it, that they are being, the systems has been implemented, they're adequate, and it is effective and operating effectively. Next, again, the subsection 3 of 134, along with subrule 8 of subsection 5, it says, in addition to the information and details specified in the subrule 4, the report of the board should also include. So apart from these things, what all it needs to talk about as the details in respect of adequacy of the internal financial control with reference to the financial statement. So this is ICFR, first is IFC. It is talking about all these financial controls at different level. So director's responsibility statement clearly mention all these things. So while section 135(4) requires director to state responsibility on internal financial controls, in case of the listed companies, auditors are required to report on the adequacy and the operating effectiveness of such control in case of all companies. So this is for the listed companies, but again, for all companies, it is required to be given by the auditors. Then next is this rule 35(4) of the Company Accounts Rule 2014. It says the board report of all companies should state that whether the adequacy of the internal financial control with respect to financial statements have been there or not. So IFC has been included as a part of the director's responsibility statement from 31st March 2015 and as a part of the statutory auditor's report from 31st March 2016 onwards. So it's been almost 7-8 years now that directors are required to report on this, and the 1 year less for the auditors. So this is one of the basic requirements why the company are required to have the internal auditors to ensure that they have an internal financial control in place. It is not only the director's responsibility statement, but Companies Act also added responsibility on the audit committee as well as on the auditors under different sections. Section 177, it says that every audit committee shall act in accordance with the terms of the reference specified by the board and shall include evaluation of internal financial control and risk management systems. It says about both IFC as well as the risk management system. So both are the responsibility of the audit committee, which has been given under sections 177. Then section 177 subsection 5 talk about that The audit committee may call for the comments of the auditor about internal control systems, scope of audit, including the observation of the auditors and review of the financial statement before their submission to the board, and may also discuss any related issue with the internal and statutory auditors and the management of the company. So the risk management and the internal financial control systems, both of them needs to be evaluated by the audit committee. So if you think that the audit committee will do it themselves, of course, they will not. They will have the internal auditors in place to do these things for them. Then section 143, subsection 3(1), which talks about the auditor's report. It clearly says that the auditor report should include whether the company has adequate internal financial control system in place and operating effectiveness. So if you see, at some places, they are talking about whether it is in place, they're talking about the adequacy. And at certain places, it is talking about the operating effectively. So when we are talking about these two different responsibilities, then internal auditor who has been appointed take care of both the things, the adequacy as well as the operating effectiveness. What if section 134 has not been complied? The directors were not complying that. There is a punishment for them, the fine as well as fee on the company as well as for the every officer in default. For company, it is 50,000 to 25 lakh, and for every officer, it could be imprisonment, which may extend for 3 years, and fine of 50,000 to 5 lakh per officer. So every officer will be responsible. That means directors who are responsible for the finance functions will be responsible for the contravention of these provisions. So it could be both or maybe just a fine depending on the nature of the negligence and the continuation thereof. If it is just a one-time offense, then of course depends if they've been caught, what would be the fine which will be levied on them. So this section talk about only the internal auditor or just the director. This consequence applies on internal auditor as well. If they fail to report the things properly. So what exactly, just to sum up what the law says, it says 134 talk about board of director, section 177, it talks about the audit committee, and 143 for the statutory auditors. So in director's responsibility statement, including the independent director is required to ensure that the financial controls are in place and they are adequate and effective. Evaluation of the internal financial control system is the responsibility for the audit committee as well. Then the auditors are required to report on adequacy as well as on the operating effectiveness. So let's see who all are responsible for what for various companies. So for public unlisted companies where the paid up capital is more than 10 crores or the turnover is more than 100 crore or the loan or borrowings in aggregate is more than 50 crores, then and the paid up private company where the paid up share capital is more than 20 crores, these provisions are applicable in respect of the implementation of the internal financial reporting, internal financial control, as well as on internal financial control over financial reporting. So the independent director or the board report, they need to carry this statement on the adequacy and the effectiveness of the IFC. Different stakeholders, company management, they need to create and test the framework. Of course, whenever anything is required, the first and foremost responsibility comes to the management. The company's management is the first one who's required to ensure that they need to implement, they need to create and test the framework for the internal controls. They need to make sure that they are operating effectively and complying with all the requirements. They should also do the documentation. Auditors need to only verify. The focus is different for the auditors. Auditors are not there for implementation, but their responsibility is limited to the evaluation of the financial reporting controls. The management is required to have all the controls in place, not just financial control. When we talk about internal controls, it is beyond finance. It could be on HR, it could be on any other activity, recruitments, admin, of course, different activities in the organization requires a proper control procedure and a control mechanism. And it is solely the responsibility of the management, the company's management, to implement, to create and implement that. Auditors are focused, when we are talking here about this, here with respect to the Companies Act, it talks about only in respect of the financial reporting or the financial controls. Anything which is beyond financial statements is out of the scope of the internal auditors as envisaged by the Companies Act. Then audit committee or the independent directors, again, what they would like to say is the robust framework is aligned to the acceptable standards or no. They will review it and question on the basis of the design and the ongoing assessments by the auditor. The next is the board of directors, who would rely on the assessments of the audit committee, and they can seek for additional information if required. This is the hierarchy and the steps for implementation, review, and the reassessment of these internal controls. Section 49 of the listing agreement, again, as a part of a corporate governance since 2002, this has been made mandatory for all the listed companies that the CEO or the CFO shall certify to the board the following matters. And if you see, these are typically the matters which related to the finance or the controls. First is whether they have accepted the responsibility of the statement. So far we talked about the Companies Act. Now it is about what has been there and implemented by SEBI. The clause 14 of the listing agreement, it is between the company and the SEBI. Another aspect on which the CEO and CFO need to certify to the board that they have accepted the responsibility for the establishment and maintenance of the internal control over financial reporting. The CFO need to certify this to the board that yes, internal financial controls were in place. They have been established and maintained. Next is about the effectiveness. Yes, it is effective and been evaluated by them. And if there is any deficiency in the design or operation, which came to their knowledge, has been rectified or is in process of rectification, the necessary steps has been taken for that. And the necessary changes during the year pertaining to the internal control over financial reporting have been indicated to the audit committee and the auditor. What has been, if there is any change in the control processes or the design, it has been communicated to the audit committee and the auditors. Next, very, very crucial and important, that significant frauds involving an employee or management having a significant role in the internal control system of financial reporting of the company have also been indicated to the audit committee and the auditors. So CEO, CFO, that is the management, needs to report to the audit committee and the auditors. Then audit committee will give it to the board after their evaluation. So there is a process which needs to be followed. So these 4-5 requirements is been there for every listed entity. Again, as a part of a better corporate governance, this has been modified and the responsibility has been given to the management to certify these. This is the certification, not just the assurance. So there is always a difference between certification and an assurance. I'm sure all of you are aware that for certification, we have to be 100% sure about it. It cannot be just an assurance. Assurance could be where you can give your opinion. They're not talking about opinion. Certification is what is there and has to be reflected as it is. So we talk about a lot on internal financial control and ICFR, the internal financial control over financial reporting. So let's understand what it is. Explanation to section 134 defines what internal financial controls means. That is IFC. So IFC is having 5 limbs typically. They talk about, it means the policies and the procedures adopted by the company for ensuring orderly and efficient conduct of the business, safeguarding of assets, prevention and detection of frauds and error, accuracy and completeness of accounting records, timely preparation of the reliable financial information. So IFC is about these 5 elements, which covers almost everything with respect to the finance. So financial control talk about all these aspects. If you see, financial control is basically what? Because internal financial control over financial reporting, it is actually a subset of the broader concept of the internal financial control. So financial over the financial reporting plus operational controls and the fraud prevention controls. If you club these 3 together, it becomes internal financial control. Let's understand what internal financial control over financial reporting means. So the definition is very clear. It talks about the maintenance of the financial record, authorization of the transaction, safeguarding of assets. So these 3 important things are part of the ICFR. It is a process designed to provide reasonable assurance regarding the reliability of the financial reporting and the preparation of the financial statement for external purposes. So the process designed to provide reasonable assurance regarding the reliability of the financial reporting and the preparation of the financial statement for external purposes in accordance with the generally accepted accounting principles. So for companies, ICFR, the policies and procedures means which pertains to the maintenance of the financial record, authorization of transaction, and the safeguarding of the assets. So the process which gives a reasonable assurance, right? So ICFR covers these three aspects for the reliability of the financial reporting as well as for the preparation of the financial statements. Hope you all understand what IFC and what ICFR is. ICFR is just a subset of IFC, and IFC is of course a broader aspect, and it covers operational controls as well as the fraud prevention controls. So why ICFR is important? Of course, for the regulatory compliances, process efficiencies, value enhancement, framework development, control design review, sampling technique, etc., etc. Most important thing is it gives peace of mind for and meet the shareholder expectation, investor expectation, maintain the reputation of the organization, as well as ensure the compliance with the relevant regulations. Gaining a level of assurance that allows the board, management, and other stakeholders to be satisfied that the organization maintains a strong system of internal control. What are the common myths about it? So just meeting CARO requirement is sufficient? No, not at all. It is beyond that. The companies has SOP in place. No need to go for ICFR or IFC. No, this is not the case. For implementation and the evaluation, even if the companies are having SOPs, the testing of the controls needs to be done on a systematic basis, on a routine and regular basis. Controls are automatically in place, hence no need to revisit them. No, it is not the case. Exceptions are always there. You cannot say that once the controls are so automatic, and there can always be a loophole which can be found in those controls. You need to evaluate and test these controls regularly based on the requirement of the business and the activity. There's no need to document the processes and controls. Without documentation, nothing happens. As a CA, we know everything and we document almost everything. And this is not an exception. So documentation of control testing, designing, each and every step is very, very, very important. There is no need to link the risk with control. We'll take it up a little later when we will talk about the risk management. See, risk and internal audit or internal controls are interlinked, and it is actually overlapping sometimes. Risks are always there. So risk management, again, is a broader aspect, which includes internal audit as well. So linking of the two is very important. The process of ICFR certification is not required since no exception was noted by the auditor. So even if there is no exception which was reported by the auditor, it doesn't mean that you're not required to report on it. You need to certify, you need to do the reporting. It is being made mandatory for certain class of companies. Testing of controls and remediation of deficiencies is the responsibility of the auditor and not of the management. This is not the case. We already understood that the testing of the controls, finding out the deficiency, implementation, this is all the prime responsibility of the management Auditors are required to, of course, give an assurance whether they are adequate or effective or not, right? So it is primary responsibility of the management, unlike the preparation of the financial statement. Implementation of the controls and testing thereof is the responsibility of the prime responsibility of the management. There is no need to provide training and development to the employees. So somebody said, what if I train my employees and they leave? So what will happen if you don't train them and they will stay? It will be a bigger mess. So ensure that your employees have been duly trained on various aspects, and even if they're part of the organization for a long time, doesn't matter, a continuous training is always required. So you need to give proper training and development for the employees on various aspects of the controls. You need to re-emphasize with them whether it has been done, it has been in place or not. So when we talk about IFC, what to do? This is just a illustrative list and a summary of what we have discussed. Objective of IFC could be operational, reporting, or compliance. So this has been divided in these three parts. The IFC requirement, accordingly, whether various activities has been taken care or not, and what to do after it has been done. So if you say the operational objectives, first is efficiency and effectiveness of operations, prevention and detection of the errors, and safeguarding of the assets. It relates to the preventive objectives, operational objectives. So in efficiency, you need to define the policies and procedure to ensure effective and efficient operations. Effective delegation of authority and entity level controls. So hope you understand the three level of controls: entity level, IT controls, and the operational controls. So effective delegation of the authority and entity level controls are there or not. And what you are required to do is define and ensure the compliances to appropriate policies and procedure and delegation of authority, define appropriate entity level controls. So defining all these things, making a complete framework that will help you in establishing the IFC in an organization, in a company. So on a different level, on our reporting objectives, again, the accuracy and reliability of the financial statement is what has been important. And when we talk about this financial statement, it has to be a timely preparation, that it has to be updated on a timely basis. It has to be completed in all aspects. And there should be adequate controls over its preparation as well. So define those effective controls and ensure that it's been operating effectively, like ELC, PLC, ITGC controls, and the fraud risk. Defining appropriate control over preparation of the financial report and adequate review mechanism and the likewise. Similarly, for the compliance objectives, compliance with the applicable laws and regulation, adequate framework to ensure compliance to the applicable law and regulation is in place or not, adequate framework to monitor those compliances. So it is not just that you need to ensure that if the framework is being there, monitoring is again very important. So legal compliance framework is what you need to check. There are various accounting assertions: accuracy, completeness, validity, cutoff, valuation and allocation, presentation and disclosures. which is the underlying assertions for any financial statements. It is very, very important to understand these assertions, because while commenting on the financial controls, these assertions need to be checked. So your focus should be on the assertion the controls is making. So key consideration in all the control is 5 W's and 1 H. So understand and document what is being generated to prove that this control was performed or not. So you need to document all these things to ensure that you have conducted IFC properly. Why is this control being performed? What type of errors should be prevented or detected? Where is the evidence of control performance retained, and it is for how long? Is it accessible for audit or not? Then when is the control performed? How frequently it is, whether it is on a daily, weekly, monthly, quarterly, etc., or annual basis. So it depends on different kind of activities for which it has been implemented. And is the frequency enough to provide, enough to prevent, detect, and correct the risk? Who are performing these controls? Does this person have the requisite knowledge and authority? Because before control testing, you should know what to be checked and how it is to be checked. And also whether you are authorized to check that or not. And last but not the least is, how is this control being performed? What activities are included? Can these activities be bypassed? Can the bypass be detected? How are issues resolved once identified, and in what time frame? Is that fast enough to mitigate the risk? So while doing the control testing, understand and document these aspects. So while doing the IFC for any organization. So now moving on to the very, very important question: how will IFC help beyond compliance? So we are talking about compliances again. So while we are talking about these compliances, how it is going to help, how it is going to work. So this, how will IFC help? It helps in business processes, because this is beyond compliance. I talk about ethics and as well as for the trust. It helps in business process redesigning to plug revenue leakages and cost containment opportunities. It also helps in rationalizing the number of controls across organization. Moving to the smart and automated controls. Also helps in standardizing policies and procedure for multi-location and multi-business companies. So when the companies are operating at a different level, then it is important to understand this. Foster a control conscious work culture for the people. Then provide assurance to the CEO, CFO, as well as improve business performances. In some instances, also serve as a base for the blueprint for optimal procedure aimed at strengthening the process for further improvement. So the IFC includes the benefit that companies would experience, includes like senior management accountability, improved controls over the financial reporting process, improved investor confidence. Then it promotes transparency within an organization, maintains the accountability of the accountability of the operational management, improvement of the audit committee and and the board senior management confidence in the financial reporting and controls. More reliable and accurate financial statement make the audit more comprehensive. So internal financial control also become essential as key drive values through a fresh, independent look at crucial business processes, identify potential operating process opportunities, and update formal centralized documentation for the company. Of course, it also helps and enhance the confidence of the CEO or the CFO certification. And it fosters a control conscious work culture that is more important, helps in business process and cost containment opportunities. So different aspects, that is where the IFC will help just beyond the compliances. Coming to a very interesting topic, risk management. Risk management, what exactly it is and how it is being defined. Risk management is basically a structured, consistent, and continuous process for identification and assessment of risk, undertaking control assessments, and continuous monitoring of exposure of the risk. So the definition of the risk management is very comprehensive. It also, if you see, it says that it is a consistent and continuous. It's a structured, consistent, and a continuous process for identification and assessment of risk, undertaking control assessment, and continuous monitoring of exposure of the risk. So when we talk about risk, what kind of risk a company faces? So there could be different risks which a company faces when it comes to their operations, when it comes to their financial reporting, and even beyond that, in an organization, when it comes to dealing with third parties, their reputation, with the vendors, etc., etc. The risk management framework is different from the internal audit, and it is very crucial for the organization to adopt it, because the risk management, again, this concept has been strengthened through Companies Act 2013 also. So while it was introduced, the companies are required to get the internal audit done. At the same time, few provisions which has been mandatory for the listed companies talk about risk management. If you see the recent SEBI LODR guidelines, LODR regulation, which has been revised, they are focusing more on the risk management committee. So with the change, the focus on the risk has increased. Risk is very crucial for any organization in which it is being operated. It is critical to value creation, offering shareholder improved stability and predictability. Of course, if the risk is under control, then the risk is not necessarily be within the organization, it could be third party as well, where you are being affected by an external party. So this improved stability and predictability to the shareholders is an important aspect which risk management focuses on. So let's see what are the regulatory requirements. Section 134, Section 177, and Section 149. 3 different sections giving responsibility to different level. As in Section 134, make board of directors responsible and it is applicable on the listed companies. Section 177 on listed company or entity with public borrowings. Even if it is an unlisted company but has a public borrowing, it is the responsibility of the audit committee. Then 149, read with schedule 4. They talk about independent directors, again, on the listed entities and entities with public borrowing. So what section 134 says? It says the board report must include a statement indicating development and implementation of a risk management policy of the company, including identification of elements of risk, if any, which in the opinion of the board may threaten the existence of the company. So they are talking broadly on the existence of the company. It is the requirement of the board of directors to include this in their board report. Like as the director responsibility statement, they need to include section 134 talks about that what would be the content of the director's report. That is where in the part it says that the risk management policy should be disclosed, and the implementation, and if there is anything which can affect the existence of the company, it needs to be reported by the board. Section 177 put a responsibility on the audit committee, where they says that the audit committee shall act in accordance with the terms of reference specified in writing by the board, which shall inter alia include evaluation of risk management system. Here the reporting is on the evaluation of the risk management system. So it is the responsibility of the audit committee. Although for the listed companies, risk management committees are also there, which take care of it in detail. But at the same time, audit committee is also responsible. Next is the responsibility of the independent directors. All of us understand that being an independent director, it's good to be to say that yes, we are a part of certain organizations. There's a process for that. You can be the independent directors. Independent director is also having a responsibility when it comes to the risk management. They says that independent directors should satisfy themselves that the system of risk management are robust and defensible. So again, it can happen while they have a proper evaluation of the risk and it's testing on a monitoring on a routine basis. So let's have an overview on the risk management, the organization and vision mission, that is why the company or business exists. Then they have the strategic objectives, which articulates that an organization seeks to do to achieve its vision, what they are going to do. Then organization structure and processes, that is where the company operates to achieve its objectives. Then there are processes and sub-processes, which is needed to achieve those objectives. And then it comes to risk. What could go wrong, which would hamper achievement of the vision, mission, or the strategic objectives. So based on different bases on the risk, again, it needs to be re-evaluated. Who are responsible? If you see, be it internal auditor, external auditor, management, board, shareholder, audit committee, process owners, it's a shared responsibility. All are responsible for managing the risk. So risk, when we just say risk, what hits your mind? Risk could be anything, be it an operational risk or a reputational. For example, if you are aware that during COVID, 2020, the use of these webinars and Zoom technology, as in these platforms, has gone up drastically for the collaboration meetings, webinar, etc. What happened in Zoom, there was a lapse, security lapse, where an unidentified intruder intruded the meetings and they were displaying some objectionable content. Later, when it was evaluated, it hampered the, so with that incidence, with just one incident, what happened is the reputation of the company has gone. People are not using it for their very crucial meetings. Of course, that was the only thing which was required to be done, but they could not do that during that period using Zoom. And later it was identified they were not using one-on-one encryption. You must have seen on your WhatsApp that yes, there is one-on-one encryption technology which they use while communicating. So anybody can see what is being happening there. So there was a lapse which added to the risk. And of course, during that some time, they lost some business. The organization lost their business because of their reputational loss. However, later on, they got that corrected and ensured that everything back in place. But yes, for some time, it happened. So it is not just the one person who is responsible, it is the complete responsibility of all. If you are aware that the owner of Tesla, Elon Musk, he tweeted something long back about their company. It was going haywire. It was somewhere in 2018 or 19. Their company was, it was a listed company. He made an announcement that it is going to be a private one. They're getting that done. So that impacted his statement on a social media platform impacted, and what happened with them is there was a steep decline in the prices of the shares of Tesla at that point in time. Of course, later on it was recovered, but yes, one statement on a social media by the owner or the director impacted the reputation of the company. So everyone is responsible. Risk management it's a shared responsibility for all. What the risk management frameworks comprises of. It talk about categorizing the information system, selecting security control, implementing those controls, then assessing, authorizing information system, monitoring, reviewing. So it's a 6-step process, monitoring, and again, going back to the same issues if there is any challenge. So it's a cyclic process which keeps on happening throughout the year, of course, depending on the frequency with the company decides. So use of the risk and control information is to improve the performance. Risk assessment and recommendations, of course, with the likelihood and the impact on any aspect, it needs to be divided. If the impact and the likelihood is low, then it is a low risk and acceptable. And onto the extreme, if you see, it's a high risk where extensive management is essential if the likelihood is significant as well as the impact is also significant. So the impact on one side and the likelihood of or the incurring of that event on the other side. So both the factors are important in assessing the risk. Ensure that the recommendations which the process owners are giving has been implemented on time based on these efforts. performing ERM-based internal auditing for effective risk management. ERM and internal audit cyclic relationship is their business operations. Again, it is about the planning and the environmental control and adequacy in the control environment. Both are very important for the business operations. So in an ERM, internal audit is a part of it. And so if you look at this ERM and internal audit cyclic relationship, these are interdependent on each other. SMART DIA, Digital Intelligent and Analytical Internal Audit Program. This is very, very crucial. It is giving 360-degree coverage. It talk about risk and resilience. It talk about statutory compliances, operational auditing, internal financial control. It focuses on anti-fraud controls and on to the analytical aspects with the advanced data analytical tools, which is available for an organization. So it's a multidisciplinary kind of thing if you see. So a SMART internal audit program gives you a 360-degree coverage if you are including all these aspects into your program. The box ticking syndrome. Yes, coming to the most crucial thing. So this box ticking, the corporate culture is most important when we talk about it. Box ticking syndrome is that you just keep on ticking the boxes. It's a formal approach which you are following. And not focusing on something which is the need of an hour now. So there is a need for organization to develop a better understanding and a common language for the risk culture. So let's understand how it is possible and what tools are available to guide the process. This culture is not a static thing. This is something which keeps on changing with time. And the culture has many dimensions, as we need to decide which of them are the most important to focus on. Assessing and managing the risk culture should definitely not be a box ticking exercise. So we understand what internal audit is. We understand what risk management is. We need to also understand what risk culture is all about. So you need to devise and decide what is important and what needs to be focused on when it comes to the risk culture. Can risk culture also fall into the box ticking trap? So the most important thing when we talk about this is shown at the top: accountability, effective communication and challenges, and the incentives for those who are playing a key role in aligning the risk. So the risk culture, use of the box ticking syndrome can be a trap if the tone at the top is different. People who are sitting at the top in the management, they are responsible for setting and communicating the institution's core values. That is where the risk culture will also be developed. The use of the term indicator to refer to the elements of the risk culture would be misleading, as it implies a linear relationship where the performance of each element can be manipulated individually. This is not the case, as it is totally an interaction of all the elements which makes the culture. And for this reason, the checklist approach for measuring culture is wholly inappropriate. Accountability of the employees who know and understand the core values must be held accountable. And effective communication throughout, there should be an open communication for that. So for these things, you cannot really do a box ticking. Risk professionals, they need to dig below the surface and gain a deeper understanding of the true nature of the organizational and the risk culture, as the basis of the understanding how culture can be both managed and changed. Challenges and emerging trends in internal audit and internal control. So when it comes to the challenges, as an internal auditor and an internal control continues to evolve, the new challenges and the emerging needs have came, and in order to be effective in your role as an internal auditor, you need to understand and ensure, you must be aware of it in order to effectively manage these risks and ensure the compliances. So here are certain, so I've listed 7 of the key challenges and the trends. Technological advancement, yes, the rapid pace of the technology change has had a significant impact on the internal audit and control. It has enabled the automation of the systems of different audit tasks as well, and increased the amount of data available for analysis, for creating new risk framework, and it also increases the certain risks such as cybersecurity threats that has been increased. Second is globalization. The rise of the globalization has made it increasingly difficult for organizations to effectively manage risk and ensure compliance across multiple jurisdictions. This has led to need for greater collaboration between internal auditor and control function across different regions and the countries. So if you see, you can do business while you are sitting here, you can do collaborations while you are sitting here, because the whole world is virtually boundaryless now. Working anywhere is not a big task anymore. It used to be a taboo long back, but now with this changes, definitely it is creating a difference. Regulatory complexity, the regulatory environment has become increasingly complex. Almost every month or two, you find certain new regulations coming in, or new laws has been introduced, be it related to anything which is having an impact on an organization. But yes, it definitely puts a pressure on the organization to stay up to date with the latest technology, with the latest changes which is happening. So regulatory complexity has been increasing day by day. Fourth is data analytics. Data analytics, of course, with the kind of data which we are dealing with, if you take a very small example of a small merchant event, the UPI payments which our organization is receiving. Just think about the big organizations who are having retail chains across. How will you ensure and keep a check and ensure that the leakage is less in that case? So see the Reliance outlets and this Big Bazaar, etc., where people are paying a small amount. They are paying through UPI. People are paying through cash, credit card, different modes of payments. Along with that, people are also using those points to make the payment. So how are you analyzing that data? How are you ensuring that the risk has been duly complied with? Because if you are just following typically the box taking approach, it is not possible to go ahead and fulfill the need of the future. Next is agile audit methodologies. Agile audit, these are, of course, getting popular day by day in internal audit, as it enables organization to quickly adapt to changing business environments and to focus on high priority risk. They are focusing on high priority risk, focus on culture and behavior. There is a growing recognition of the importance of the organization culture and behavior and internal audit and control. It has led to a focus on assessing and improving culture, on developing more effective communication strategies to engage employees in the risk management process. Next, sustainability, of course, with the increased focus on the ESG, sustainability has emerged as an important issue for many organizations. And the internal audit function are increasingly expected to address sustainability risks and opportunities. Of course, there are a lot of opportunities with the risk which has been faced by an organization. Refocusing on risk assessment. Again, the starting point to this, it is important to refocus on how the risks are being assessed. Which controls are necessary to address the company's risk? How many controls does the company needs? And what is just enough for the company's ICFR program? These are the fundamental questions. These three fundamental questions are required for risk assessment. And it is really important for an organization to focus on that. So what can a management do to refocus? Of course, what they can do is they can refresh the risk assessment program, and of course, integrating more data analytics and visualization to improve the quality of the data analyzed. So based on the data, whatever is available with them, it is the role and responsibility of the management if they proactively work on it. Refocus on management review control. Management review control are basically the reviews conducted by the management of estimates and other kind of information for accuracy. So at the core, providing management with the insights on key success factors, common challenges, examples of modernizing and renewing ICFR program is critical. It will create a roadmap for increasing financial reporting reliability and decreasing the compliance cost. So it has to address these three issues. First is, of course, the high compliance cost. Second is updated ICFR program and a continued focus on ICFR by the regulators. A refocus on robotic process automation. RPA is talk of the town now. Those who are in internal audit, they understand that RPA, the use of the bots, use of automated procedure for the routine and the repetitive activities has increased multi-folds over a period of time. If you see what this RPA effectively means, if you go to any bank or go to any websites, you see that go and ask, there is a bot, chat bot, on which you type. They also give you certain preset questions for which they have answers. Of course, these are different things. It is really important. Those who have not adopted RPA so far, it's a time for adoption of the automated procedures. The AI is again working on it. These are getting effectively. The role of the internal auditor will also change over a period of time in the years to come. Different organizations are using data analytics. They're using, the focus is increased on machine language and the artificial intelligence. So with all these things coming in consideration, it is important for the companies to refocus on the RPAs, because it comes with a lot of benefits like greater business flexibility, increased customer satisfaction, improved productivity and accuracy, increased cost savings, and quick scalability. Of course, there is a shift in the way people used to conduct the business. And now with the new ways, as an auditor also, we need to upgrade ourselves to ensure that we should keep pace with the time, with the kind of businesses which we are dealing as our clients. So practical implementation for risk professional to avoid box ticking approach and gain deeper understanding as to how culture works in our organization and how to manage it. We need to follow this 3Ds procedure. One is discovery, discover, design, and delivery. Discovering is, of course, that is the base research where you are synthesizing that idea, drawing the scope. Then onto the designing part, ideate, prototype, and validate. Then development, implementation, test, and deploy that. So initially it is a problem space, and then moving from a problem space to a solution space. So leaders are those who play a very, very important role in this aspect. So this is where it is very, very important for the risk professionals to understand and work on it. Thank you so much, everyone. If you have any questions, please let me know.
Thank you, Sanaji. It was a very exhaustive, informative, and engaging session. And you have very exhaustively covered all the topics related to internal audit, internal finance, internal controls, risk management, etc. So let us have a question answer session if anyone has questions. Arunji, is there any questions? There seems to be some problem, I think. So the responsibility of the internal auditor is not towards the company management only, but they have accountability, responsibility towards all the stakeholders of the company, such as investors, then creditors, financial institutions, government agencies, government departments, they are accountable, responsible for them also. So they should have an independent existence, whether they are employee or whether they are externally appointed. In both the categories, they have to be they have to keep their independent integrity in mind. There is a huge change in role in internal auditors from reactive to proactive. That is a very good term. From books to business. Yes, we do not have to limit ourselves to the books only. We have to think whole business as such for our scope, though it is not specified, but we have to think of it. Then yes, we auditors cannot have a stern look always. They should be smiling. They should extract information with a smile, and they should convince the management, the employees, the stakeholders that they are there to enhance the efficiency of the companies, not as a problem provider like that, but they are solution provider for the problems. And Sanaji have very aptly discussed the new and emerging challenging areas like data analytics, artificial intelligence, RPA. All these things will play a great role in our internal audits and review of internal financial controls, etc. Recently, there have been instances of very big banking frauds. So the whole chain will going to get affected, from internal auditors, independent auditors, independent directors, then statutory auditors. All these are going to be affected. So just ticking the box that will not give the results, but we have to open the locks of the box and see the contents inside. Then only we should tick the box. Otherwise, there are huge implications.
I would like to add one thing over here. While you are saying that, yes, with the latest frauds, the first question which always comes is, where were the auditors?
Yes. Even NAFRA has imposed heavy penalties on few chartered accountants recently. So yes, we have to be very cautious with our audit work at every step, every stage. I think there are no questions right now. Hello. Okay. So if there is no question, we close the meeting. We are very much thankful to Sana Madam for very, very exhaustive and very creative PPT you have prepared for a very better understanding of the topic. Thanks a lot.
Thank you so much, everyone, for being with us throughout the session and listening to me patiently. Hope you understood the concept that now it's a time to embrace the change and understand our responsibilities in much better and in a futuristic manner.
Thanks.
Thank you, everyone.